Welcome to the Hurst Trading Room Live. My name is David Hickson and today is the 27th of June 2016. As always, before we take a look at the markets, please make sure that you have read and understood these disclaimers. Well, a big welcome to everybody. Thank you so much for joining me. In today's webinar, I am going to be speaking about something that is very much on all of our minds, which is the idea of news events and how news events impact financial markets. Wasn't last week an extraordinary week? Well, I shouldn't say last week was an extraordinary week. There was really one extraordinary day in last week, which was, of course, Friday, following the Brexit announcement. Everybody in the UK, or not everybody, but many people in the UK went and voted for the referendum as to whether they should stay in the European Union or not, whether they should leave the European Union. And the results were announced Thursday night, UK time, and in Europe, and had a dramatic effect on financial markets. And this is something that we are seeing with increasing frequency, in my opinion. But I'll get to that towards the end of the webinar. The important thing is that news events definitely affect financial markets. And so I thought it would be interesting in today's webinar to discuss from a Hurst cycles point of view, what do news events do to financial markets, and how do the cycles work in conjunction with those news events? What is happening? What's going on in the markets? First of all, let me explain to you what Hurst had to say about news events, or what he called fundamental interaction. Fundamental means that it is something that doesn't have to do with the technical aspects of the market, basically price. So it's not directly related to price. It's a fundamental event, such as a news event or an economic announcement, or sometimes it could be a natural disaster, but it's something which is outside of the financial market as such, and it has an impact on the financial market. Hurst spoke about fundamental interaction. And I must tell you that, although of course this is the Hurst Trading Room and I speak about Hurst cycles at great length, in today's webinar I'm going to be speaking about what Hurst had to say about news events influencing financial markets, but I'm also going to be applying a good deal of sort of a Hickson angle, my own personal angle, which is how I see the way that Hurst explained fundamental interaction and how I work with it. So not everything I'm going to be speaking about today is strictly speaking Hurst. If you're a Hurst purist, you might find yourself disagreeing with me. That's no problem, but it means you are probably disagreeing with me as opposed to Hurst, just so that you know that, particularly if you are new to Hurst cycles. Well, what is fundamental interaction? It is simply the interaction between a fundamental event, such as a news event, such as, of course, Brexit, or the announcement of the results of the referendum. It's the interaction between that news event and financial markets. As you know, thanks to the principle of commonality, all financial markets move with a great deal in common. And so when you have a big news event, something that is of sort of global magnitude, as Brexit is really, although Brexit affects people in the UK, probably most out of everybody in the world, it also affects Europe as a whole. And given Europe's history, and particularly its turbulent history with world wars and so forth, the fact that the UK is leaving the European Union is something that could be seen to have a global impact. And because financial markets all move with a great deal in common, we find that financial markets all tend to react to news events, even if it isn't a news event that is specifically located in that particular market. Now, Hurst said that fundamental interaction causes a great deal of volatility in the market. What is volatility? It means very fast moving prices. So it causes a great deal of volatility, but it doesn't really change what's happening in the markets in terms of what the cycles are doing. It's a very important point, because it brings us to that very important question that so many people who are new to financial markets often ask. people who are new to financial markets often are of the opinion that financial markets are moved because of news events. In other words, a financial market will go up because of positive news surrounding that market, such as good economic results for a particular company will result in rising stock prices. In fact, that is not true, and I'm not going to present endless examples of how it's not true. I encourage you to investigate this for yourself, but you probably know, if you're here in the webinar, that it's not entirely true that markets are moved because of news events. And in fact, I'm going to insert a word into this sentence over here, and if I can turn this pen on. Let's see, this pen is proving to be a little bit reluctant. There we go. Okay, I'm going to insert a word here, and it's again that word meaningful. Do markets move meaningfully? If I can write the word meaningfully. Do markets move meaningfully because of news events? That's really the question that that we have in front of us today. What do I mean by meaningful move? The dramatic move in all markets on Friday was very meaningful for people who had money in those markets. Clearly that was a meaningful move, but that's not what I mean by meaningful move. We analyze markets because of the cycles that are active in those markets. And so by a meaningful move, I mean a move that has some meaning in terms of our analysis of that market. So it's got nothing to do with the size of the move or the direction of the move. It's got to do with whether it is meaningful in terms of our analysis, because all of our trading decisions are made on the basis of the analysis that we're performing. And so for a price movement to be meaningful to us, it needs to have some relevance in terms of the analysis that we're performing. So the big question is, do markets move meaningfully because of news events? And my suggestion is that they do not. Markets definitely move, as we all witnessed on Friday. They move very strongly because of news events. But I suggest that they do not move meaningfully. And Hurst didn't say this in exactly these words, but when he was speaking about fundamental interaction, this was, in my opinion, his implication, that there is a tremendous amount of volatility surrounding big news events, but that the moves are not meaningful from a cycle analyst's point of view. Now, why does this happen? Why is it that markets don't move meaningfully because of news events? And why do markets have a tremendous amount of volatility? Why do they move so strongly and yet not meaningfully because of these news events? I'm pleased to see William agrees. Often when you start speaking about this kind of thing, you find many people disagreeing with you, but it's a fascinating topic of discussion. So whether you agree or disagree, I hope that you will listen to the argument and take something away from the argument in terms of understanding the markets a little better yourself. The reason why I believe news events cause tremendous volatility and do not cause meaningful movements is because of the way in which markets work. Now, what do I mean about that? Well, in order to discuss the way in which markets work, let's take a look at the British pound to US dollar, which was dramatically influenced by the results of the Brexit referendum. Now, this is a very long-term chart of the British pound to US dollar. That blue line is the line of the closing prices, the daily closing prices going all the way back to 1975. So we're going to spend a bit of time looking at this analysis in a moment. But what do I mean by the way in which markets work? Well, you know, I live in Italy at the moment. I live in a beautiful town, and every week on a Tuesday morning there is the town market, and people come into town to sell their goods, whether they be vegetables or shoes or hats or anything really, and people come into town to buy those things. And that is a really traditional market. And the way in which traditional markets move is that if there is demand for something, then the person selling that thing can raise the price. So we get the sort of traditional idea of markets that when there is high demand, prices rise. And when there is an excess of supply, so in other words, you've got a lot of a particular thing, somebody's selling lots of vegetables, but everybody's growing those vegetables in their garden at home, then there's not very much demand, and so the price drops. That's the way in which a traditional market works. And one might argue that over a long period of time, if you're looking back over many years, you might argue that that's the way in which all markets work. I'm not sure that's entirely true. But let's consider for a moment this currency market. This is the relative value between the British pound and the US dollar. Now, currency markets developed because, of course, you live in a particular country and you earn money in that country's currency and you buy things with that currency. But nowadays that we've become a big global village and you can buy things from all over the world, if you're living in England and spending British pounds and you want to buy something from somebody in the United States who wants to sell that thing for United States dollars, you have to work out how much your pound is worth relative to the United States dollar. Obviously, that's how currency exchanges work, and that's what that is all about. And you might argue that over time, the graph that we're seeing here is a true indication of the strength of the British pound against the strength of the United States dollar. Now, what causes those fluctuations in value? Well, I'm tempted to say the cycles do, but I won't jump straight to that. What causes those fluctuations? Could you calculate what is the real value of a British pound against the United States dollar? Yes, you probably could. You could look at the strength of the economy in England and the strength of the economy in the United States. You could look at the cost of living. You could probably work out a very complicated formula and therefore work out what the relative value of each of the currencies is. In fact, people don't really do that because of the way in which markets work. And now this is where I think the argument gets really quite interesting. This is a chart of daily prices. We're looking back over 40 years, all the way back to 1975 for the British pound to US dollar. Let's take a look at a different chart of the British pound to US dollar. Here is the same thing, British pound to US dollar in MetaTrader 4 trading platform. This is a 15-minute chart. Now, in each one of these bars, the value of the British pound to US dollar is fluctuating, as you can see. And we can look at shorter and shorter time frame charts. Here's a 5-minute chart. This is what's happened over the past few hours. We can look at a 1-minute chart. Okay, here you can see, isn't that amazing how those FLDs keep working even on 1-minute charts? But let me not get distracted by that. The important point is that the value of the British pound against the United States dollar is fluctuating second by second, or many times every single second. That value is fluctuating. Why is that? Is it really the case that the British pound is worth a little bit less than it was a few minutes ago? In my opinion, that's not really true. And that's because of the way in which these markets work. What's actually happening here is you have a bunch of people, it's quite a big bunch of people who are making the market. They're called market makers, and they're making the market. They're making trades. They're buying and selling pounds or dollars. And they are not making the market on the basis that they think that the UK over the past few minutes has increased in strength relative to the United States. They're doing something very different. They're simply buying and selling. They're playing a different game, if you like. And so what happens on a very short time frame is that you have people who are making trades. They're buying and they're selling very quickly, and they're trying to find people who will buy for a particular price, and then they're trying to find people who will sell for a particular price, and so on. So you have something quite interesting happening on a very short time frame scale, which has nothing to do with what we think of as being the meaning behind the market. So, and don't get me wrong, movements intraday are not random because of this, but they are, in my opinion, effectively meaningless. I'm not going to look at this and say that the British pound really is, really is worth less than it was 6 minutes ago, because I don't believe that's what this is about. But in the complex arrangement of the market, that's what's happened to that price. So a really fascinating thing happens in markets. On a very short time frame scale, you have something slightly different happening to what you expect markets are all about. And that's why I believe you can get tremendous volatility and great price moves that are effectively meaningless, because they're not really saying anything about the relative value of the British pound against the United States dollar. It's just to do with the way in which the market works. Okay, and that is why I think the markets, when a big news event happens, are very vulnerable to moves. Why? Well, because if we have a look at this chart, you can see that there is some continuity in the price movement. All right, you know, every minute when price is trading, there's generally an overlap with the minute before. That's called price continuity, and you know, sometimes price spends a couple of minutes at one particular level, or many minutes at one particular level, and it sort of moves back and forth, not doing very much, and there's continuity. So there's a sort of a history and an understanding of what the British pound was worth relative to the United States dollar 5 minutes ago, 10 minutes ago, a couple of hours ago. Now, what happens when a news event occurs, or an announcement is made, or something happens? What happens, in my opinion, is that the people that are out there trading this have an opportunity to move the goalposts. And that's what they do. It's got nothing to do with them suddenly realizing that the British pound is worth something completely different to what the United States dollar is, or to what it was, you know, a few minutes ago. But what they are able to do is very, very quickly move those goalposts. So in fact, let's, on this chart, go back to Thursday night and have a look at what happened there. If I scroll this chart back, okay, first of all, here is a big jump. Can you see that? Price just jumped from that bar to that bar. What is that? That's the weekend. Okay, this bar on the left, where the cursor is now, is the last bar on Friday, and this bar here is the first bar on Sunday night. So that's a big jump over the weekend. Weekends, of course, also offer the opportunity for the traders who are out there making the market to shift the goalposts. They can just you know, start somewhere new, somewhere completely fresh. But let's just go back to the time of the big announcement. This is a 5-minute chart that we're looking at now. And so let's just have a look here. Okay, so here we are, Thursday night. The right-hand edge of this bar is Thursday night, about 11 o'clock at night, perhaps midnight. The server time here is, I think, Central European time, something like that. So here you can see some fairly good price continuity. Okay, there's an understanding of what price has been doing, and it's changing slowly. In fact, it's changing very slowly, because before a news announcement, markets generally get very, very quiet. Then we move forward just a minute or two. Well, no, this is 10 minutes, because each one of these bars is 5 minutes, and you can see this very strong move down below here. What's happening? Has the value of the British pound suddenly plummeted in the space of those few minutes? No. What's happening is the people that are making the market, the people that are doing this, are shifting the goalposts. And they're trying to work out where they can shift the goalposts to. Because these people are not some tremendous sort of prophets that know what the value of the British pound is. They're simply looking to see where they can move these goalposts to. And so they moved it down very hard and very fast, and then they moved it up very hard and very fast. So they moved it down for about 5 minutes, they moved it up for about 10 minutes, and then it sort of fiddled around a little bit, and I've sort of jumped ahead, and then it started coming down again, and then it dropped very strongly, and then it fiddled around, dropped very strongly again, came back up again, dropped very strongly again. Okay, my point is that what's happening here is not that the world has suddenly woken up to the fact that the British pound isn't worth what it should be, what it was, or what it should have been worth. What's happening is that the people that are making this market are shifting the goalposts. And it's something that happens particularly strongly in currencies, more strongly in currencies than in the stock market. It's a very important thing to bear in mind if you're trading currencies. But what's happening is that the goalposts are being shifted. Okay, so now that's what I believe happens in terms of markets. Okay, so when a big news event comes out, you've got people that are shifting the goalposts. Now, in which direction are they going to move those goalposts? That's a really interesting question. And does it depend on the news event? If, for instance, the results had been that the UK had voted to stay in the European Union, would the British pound have gone up instead of down? It's a really interesting question, and of course nobody can give you that answer because it didn't happen. So nobody can stand up there and say, well, it would have gone the other way. In my opinion, it makes no difference what the news is. That's a really important point. That's my opinion, of course, and I might very well be wrong. I've been wrong before. But in my opinion, it makes no difference what the news event is. The fact is the news event is simply used to shift the goalposts. And so how can we understand what's happening with the shifting of these goalposts? The tremendous volatility that we saw on Friday, was that an indication? And let me just show you a chart that includes Friday's move in the British pound US dollar. Here we go. Let me just zoom right in. And let's have a look at the last several months, and turn off those semicircles. Okay, you see this big red bar over here. It's kind of hard to miss. That big red bar over there is what happened on Friday, and it's continued to happen today on Monday. So that was a really big turnaround and a very strong move. I think it was about 15%. Really big move. That is what volatility is. Welcome to volatility. That's when the price moves very fast and very strongly in a very short space of time. I guess that's the definition of fast. But let's take a look and see what we might have expected. And so the first chart that I want to show you, let me just reset the scale and turn those on again because I want to show you this chart again in a few minutes. Let's come here to the British pound US dollar. This is the long-term chart, prices going back to 1975. And this chart only includes data up to Thursday night. In other words, before the news announcement had happened. So on Thursday night, I was looking at the British pound US dollar wondering, okay, so what might we expect to happen? Well, as a cycle analyst, the first thing you're going to want to do is you're going to say, well, what are these cycles doing? Okay, and so here's the really long-term analysis. You can see that we had an 18-year cycle trough over here in 1985. That's 1985. I've drawn over it so you can't read it. Very useful. Here's the next 18-year cycle trough in 2001. Okay, and so the next 18-year cycle trough, as you can see from this red semicircle over here, is expected when? According to this analysis, it's expected pretty much in about 2017. In other words, next year, we're expecting a trough of the 18-year cycle. Now, when a trough of the 18-year cycle forms, what happens? Well, prices move down into an 18-year cycle trough. So what's the really big picture in terms of the British pound to US dollar? Did things suddenly change within the space of a few hours on Friday morning or Thursday night? No, I don't think so. The big picture is that the 18-year cycle trough is expected to form sometime in the year 2017. Let's have a look at a little more detail over there. So let's, what should we do? Let's have a look at these 18-year cycles, and let's have a look at the M shapes. There's the M shape for that 18-year cycle. That looks like a good M shape, slightly distorted, of course, as they often are. Here's the next M shape, and what's busy happening now? Well, at the really big scale, it looks like price is heading down into that 18-year cycle trough. So let's zoom in, and we can look at the most recent 18 years, and we had price move up very strongly and then come down very hard into this trough over here in 2009, I think it was, or end of 2008, which is the 9-year cycle trough. Okay, so let's zoom in and have a look at the most recent 9 years. What has happened since then? Well, we've had price come up and form a sort of a, this is a typical sort of a triangle formation, and the end of that triangle formation was the 4.5-year cycle trough, 54-month cycle trough. Then we've had the next move up, and now we've got the move down into the 18-year cycle trough. So let's focus on this 18-year cycle trough, and let's zoom in on the most recent 54-month cycle. Here we go. So you can see that here is the nest of lows for the 18-year cycle trough that we're expecting. There's the actual circle for the 18-year cycle, and here is a very staggered nest of lows, very staggered because we can't tell all the finer details just yet, but you can see that generally that 18-year cycle trough is expected sometime in 2017. Is it possible that that 18-year cycle trough has formed already? Well, on Thursday night you might have been asking yourself that question. You might have been saying, is it possible that that 18-year cycle trough has formed, and that it formed over here at the trough in, where was that, end of February, I think. Is that possibly the trough of the 18-year cycle, and are we therefore going to see that the market is just heading up strongly? Because you can see that in last week, up until Thursday night, the British pound did gain in strength and it was moving up quite strongly. You've got to be very careful as markets approach a news event, because very often they can make deceptive moves as prices approach that news event, because we're waiting for the traders to shift the goalposts and we don't necessarily know in which direction they're going to do that. And so you often get deceptive moves just before a news event. That is if it's a known news event, of course. So what do we see here? Well, this analysis shows 1, 2, 18-month cycles which are complete. But if we have a look at the price movement, it only really looks like one cycle. So there's a bit of a question mark about that. It's quite possible that maybe this should only be an 18-month cycle. But even if there are 2 18-month cycles, is it possible that this trough in March was the next 18-month cycle? Well, no, it's not really possible, and I can show you by measuring some distances. If we measure from the trough in, where was that, July of 2013, up to the trough in April of 2015, you can see that was 21.1 months. So that's either a very long 18-month cycle, or it's 2 short 18-month cycles. And as you can see, the analysis here shows 2 short 18-month cycles. But more importantly, since then, is it possible that the 18-month cycle trough formed over here at the end of February 2016? In my opinion, it's not really possible. Only 320 days. That's 45.7 weeks. So no, it does seem more likely that the analysis we're seeing at the foot of this chart is probably more correct in terms of that more recent price action, which is this action since the 18-month cycle trough in April of last year. So that tells us that we're still expecting a trough of the 18-month cycle. You can see here is the circle of the 18-month cycle, and the exact date that circle is on is the 3rd of July, next week Sunday. And here is the very neat nest of lows for this 18-month cycle, forming an inverted triangle over here. So you can see that if we'd analyzed the market on Thursday night before the Brexit news announcement, you can see that we were expecting price to come down into an 18-month cycle trough, which is just the next step on its way down to an 18-year cycle trough expected next year. So what is our overall perception of the British pound to US dollar? Was it, heading upwards according to our cycles? No, quite the contrary. It was heading down to an 18-month cycle trough. It had experienced a bounce at the end of February, and it had experienced another bounce at the beginning of last week, or was it 2 weeks ago? But it had recently experienced some bounces. Neither of those bounces look very likely for the 18-month cycle trough. Possible, perhaps, just barely possible, but not very likely. And so generally, we're looking at a market coming down into an 18-month cycle trough. So let's have a look at a different chart of the British pound to US dollar, which is the chart that I showed you a moment ago, which is receiving the live data. And here you can see I've loaded less data. In the previous chart I had 40 years worth of data. In this chart I've got only not even 10 years. I think this goes back to 2004. Now I've got 12 years worth of data. I think it's really useful to analyze different data periods. It sometimes reveals some fairly interesting things about the analysis. Particularly when you load less data, you get more of a focus on what's been happening recently. One of the big dangers of loading 40 years worth of data is that your cycle wavelengths are potentially being influenced by what happened 35 years ago. And is that really applicable? I don't know, but I do like to keep an analysis going which focuses more on the recent time period. This is the most recent 12 years, and you can see there isn't very much difference with this analysis. We had a 54-month cycle trough over here in 2009, I think it was. We had another 54-month cycle trough over here in 2003, was that? So in that regard, this analysis is exactly the same. The analysis is a bit different in terms of what's happened since then, because as you can see, it has only counted one 18-month cycle since then, and it has counted this long 21-month wave as being a single cycle of the 18-month cycle, okay, which is probably really a better analysis. What it means is that it looks as if though the cycles are running slightly long at the moment. So if we zoom in even further on this analysis, what does that tell us, or what would it have told us we were expecting? Well, you can see that the trough that formed at the end of February over here was a trough of only 40-week magnitude. Okay, and here is the nest of lows for the 18-month cycle. So the 18-month cycle, according to this analysis, is only expected right at the end of this year, end of 2016. So which way is this market moving? Was it a big shock that on Thursday night the British pound went down? No, I don't think it is, because I do believe that the market is heading down into an 18-month cycle trough. I think that this analysis we're looking at here is probably a more accurate analysis than we were looking at on the previous chart. And if we zoom all the way in, we can see what we are likely expecting, which is that the market is now going to bounce out of a 40-day cycle trough. So it should be bouncing fairly soon out of a 40-day cycle trough. Then it's going to come down even further into a 20-week cycle trough at the beginning of August. Then highlights for the rest of the year, about the middle of October, we've got an 80-day cycle trough, and then the big 18-month cycle trough probably in December. Of course, as we get further down the line, we can refine those timings a little bit. But the important point here really is that the market, in terms of the British pound to US dollar, very much looks as if though it is heading down into an 18-month cycle trough. And so it wasn't really a very big surprise for me that the British pound to US dollar dropped. Personally, I think the British pound to US dollar would have dropped regardless of the results of the Brexit vote. But you might have a different opinion, and we could probably discuss that at length. But let's do something else on this chart, and let's ask ourselves what was the peak analysis doing. Now, I'm not going to go on about this at length. You know now, if you've been watching recent webinars, that Sentient Trader can perform what we call a dual analysis. I spoke about it at length in our previous webinar about the composite model line. And Sentient Trader can perform an analysis of the peaks, and it can separately perform an analysis of the troughs. We won't dwell on it now, because we could spend hours speaking about just that one concept. But here's the important thing, in my opinion. This analysis, and this is a default analysis, I haven't done anything to influence this analysis, so the software is just doing an analysis with the data that I've shown it. And you can see here a very delayed nest of highs for what cycle? the 18-month cycle. So in other words, the market was looking at moving into an 18-month cycle high. Okay, and what happens when the market reaches an 18-month cycle high? Well, it normally turns around and heads down towards the 18-month cycle low. So just looking at the circles and whiskers for the 18-month cycles, if this was the 18-month cycle high, which now seems very likely, then we can expect the market to keep coming down into the 18-month trough over here, which, as I've mentioned, is November, December, towards the end of this year. Now, before you think that I'm suggesting that before a major news event, you take a look at your analysis and you look at these nests of highs and nests of lows, and you work out which way the news event is likely to cause the market to move. I should point out that that's not a very reliable way of doing things. I've had the great privilege of working with a lot of people who use Hurst cycles to trade financial markets, and I have spoken to and worked with several people who actually trade news events. And when it comes to trading news events, and they do so very, very successfully, I must tell you, they make some good money out of trading these news events. But when it comes to trading news events, they mostly rely on other tools to determine the trades that they're making. In other words, Hurst cycles are great for deciding what you think the markets are going to be doing, but I must warn you, when it comes to big news events, don't rely entirely on your Hurst cycles analysis to tell you what to be doing, because of the whole fact that I believe fundamental interaction is all about tremendous volatility and very little meaningfulness in the price movement. And when we're looking at Hurst cycles, we're looking for some meaning, of course. And so, although there's a strong argument here for an overdue 18-month cycle peak and an 18-month cycle trough in the future, I don't want to suggest that you use that kind of reasoning for making your trades for future news events. You have to be just a little bit careful about that. So that's the British pound to US dollar, which of course was very, very strongly affected. And in my opinion, it wasn't really a big surprise that the British pound to US dollar has moved lower. And the goalposts have shifted lower. But it doesn't mean that the cycles are not working. We had such a strong, dramatic move. We couldn't really have anticipated or traded that move purely on the basis of our cycle work. But it wasn't a surprise, in my opinion, that it ended up being a move downwards. There's a great saying when you're working with Hurst cycles, that is that the Hurst cycles tell you in which direction you should expect surprises. So you might have performed this analysis and said to yourself, I expect surprises to happen to the downside. In other words, I wouldn't be surprised to see prices moving to the downside. But now, what about stock markets? Because not only the British currency was affected by the Brexit vote, but of course the Footsie, which is the UK stock market, was also tremendously affected. How was it affected? Well, again, it was affected with tremendous volatility. And so when you are expecting a news event, as we were, I mean, the date for the Brexit referendum was announced years ago, if I'm not mistaken. Certainly it was confirmed many months ago. So we've had a long time to prepare for this. And the one thing that you should know is going to happen is tremendous volatility. Here is the UK stock market, the Footsie. And we've been discussing stock markets at length in our previous webinars, so I don't really need to dwell on this very much. Let me point out the highlights. First of all, here's an 18-month cycle trough, which I've been looking at and speaking about for some months now, which formed in the second week of February. And then during this time over here, in May, as you probably know, I was considering the possibility that an early 20-week cycle trough might have formed. Let me speak about that for a moment, because perhaps you're still in that sort of mode of thinking that a 20-week cycle trough formed there in May. And it is possible. let me pop up an FLD. I think I've got the 20-week FLD here. There we go. There's the 20-week FLD, although in fact this argument is better presented on the chart of the S&P 500, which we're going to do in a moment. So perhaps I should delay that discussion until I get to the S&P 500. The important point is that this trough over here in May at 98 days was possibly an early 20-week cycle trough, and we entered into a long trade, or discussed entering into a long trade in the S&P 500 on the basis of that trough, which turned out to be a profitable trade. But as a Hurst Cycles analyst, you're constantly looking at what's happening in the markets, and you're constantly asking yourself, how does this affect my analysis? And you can see the default analysis presented at the foot of this chart is what the software is suggesting is happening at the moment. And I've turned on the wrong pen. There we go. And that is that an 80-day cycle trough occurred over there. A 40-day cycle trough occurred over there in the middle of May, and price is now coming down into this nest of lows, which is the nest of lows for the 20-week cycle trough. So that is what it looks as if though we are expecting for the Footsie. So as opposed to the British pound to US dollar, which is heading down into an 18-month cycle trough and an 18-year cycle trough expected sometime next year, the Footsie, the stock market, although it's heavily reliant on the British pound to US dollar exchange rate, has a slightly different picture. And stock markets tend to be more resilient in terms of bouncing back following news events. Currencies tend to be affected a little more deeply, and you'll see the after effects of news events affecting currencies for days, sometimes weeks afterwards. Stock markets tend to be more resilient. That's a broad generalization, but it's something that I've found to be true. And so, as you can see, the Footsie came down very strongly on Friday, and spent the rest of Friday bouncing back up again, and in fact closed the week at roughly the level of the close of the previous week. That's true and typical fundamental interaction from a Hurst Cycles point of view. When you see sudden dramatic movement in one direction followed by a bounce back, leaving you pretty much where you started. So that's what we saw happening in the Footsie, and as a matter of interest, we can take a look at the Footsie on the trading platform as well. And let's see, I think I've got the Footsie over here. Here we go. Here's a 1 hour chart, and you can see this is the cash index, not the futures. So you can see that when everybody went to bed on Thursday night, having traded the market, they were feeling quite good, because the market had been trapped in this very, very narrow little range, moving upwards, and it was looking quite good. Friday morning they woke up, and here you can see at the foot of the chart the circle for the 10-day cycle trough, and there's the 5-day cycle trough. So the market had just dropped overnight, which is the kind of thing that happens when news events happen. I also have to point this out. You know how much I love FLDs. Look at how price came back up to the 5-day FLD on Friday. This is an hourly chart. Came up to the 5-day FLD, and that is where the price found resistance on Friday. And as William says, the ES went limit down. So the ES went down its maximum limit. I'm sure you all know what limit means. The ES went limit down. So we had a tremendous amount of volatility in those markets. Let's just go back and have a look at a few other things in the Footsie on this chart over here. Let's also have a look at a peak analysis here on the Footsie. Here again you can see the nest of highs for the 80-day cycle peak, and this looks very possible here for the 80-day cycle peak forming over there. And can you see how it is almost sort of simultaneous with this 20-week cycle trough? And you might be saying, how is that possible? How is it possible that you can have a peak simultaneously happening with a trough? Well, it is possible because those are two separate analyses. Remember, Sentient Trader is performing an analysis here on the peaks, and is performing a separate analysis on the troughs. And so it is entirely possible, when you have two separate analyses, that both analyses are saying, I'm expecting a peak now, and the other analysis, or the one analysis is saying, I'm expecting a peak, and the other analysis is saying, I'm expecting a trough. When you have two analyses lining up like that, one expecting a peak and the other expecting a trough at roughly exactly the same time, that is the opportunity for very strong, very volatile moves. So it made perfect sense as we approached Brexit. It made perfect sense that that we were going to see a very strong move such as we did. As a matter of interest, you could also say this is an 80-day cycle peak over here. So price formed the peak, then came down into a 20-week cycle trough. 20 weeks is stronger than 80 days. And so therefore, it's more likely that this market is going to recover and bounce out of this trough, compared to the British pound to US dollar that we looked at a moment ago, which is more probably only forming a 40-day cycle trough in the markets at the moment. So it's being repelled, the British pound to US dollar is being repelled from above by an 18-month cycle peak, and it's being supported at the bottom by a 40-day cycle trough. No wonder the British pound US dollar is keeping moving down, whereas the Footsie is being repelled by an 80-day cycle peak up at the top and is being supported by a 20-week cycle trough at the bottom. You might argue that that kind of discussion is prone to error, to be honest. As I've mentioned, I would not recommend trading your big news events on the basis of Hurst cycles reasoning of any kind, because the volatility tends to be fairly meaningless with regard to your Hurst cycles. So yes, we could argue that the Footsie is now being supported by a 20-week cycle trough and therefore is more likely to bounce up than the British pound to US dollar, but you need to be a little bit careful with that reasoning, and I'm not presenting it here as a way in which you could have successfully traded this big volatile move. How could you have or should you have traded this big volatile move? You could have or should have done it using other tools. Perhaps that's bad news for you, but Hurst cycles are very, very powerful, and you can work with them intraday. You know, as I've demonstrated, you can work with them intraday and work with FLDs and all that kind of thing. But you need to be very careful at the time of news events that you're not making Hurst cycles meaningful decisions around a time where there is simply going to be a huge amount of volatility and not very meaningful moves. I see Paul Smedinghoff says, what type of tools are effective during news events? Paul, there's a huge range of tools, really kind of beyond the scope of not only this webinar, but also my knowledge and experience. I know that people that I speak to use a very big range of tools, particularly a lot of fairly standard technical indicators, stochastics, moving averages, and you know, volume profiles, and support and resistance levels, that kind of thing. The people that I've spoken to who consciously and positively trade news events tend to work with Hurst cycles often as their primary decision tools when trading, and there aren't any news events. But when there are news events, their Hurst cycles tools fall into the background slightly, and they work with other more traditional technical analysis tools. They look at patterns in the markets, you know, head and shoulder patterns, important support and demand levels, support and resistance levels, and so forth. So I hope that answers that. It's way beyond the scope of today's webinar. But my suggestion is, as you're approaching big news events, don't overanalyze your Hurst cycles, okay? Because I don't believe that your Hurst cycles are going to provide you with everything that you need in terms of making the correct trading decisions. That's really perhaps, you know, quite an important message from today's webinar. And I'm sorry if it's disappointing. Hurst cycles are wonderfully powerful, but they don't necessarily provide you with absolutely everything that you need in order to trade markets at all times. Let's throw up another tool here, the Composite model line, which is a tool that we spoke about in last week's webinar. I won't go into great length again explaining how it all works, but here's the composite model line. You can see, I think the cycles that I'm showing here are a 40-day up to 18-month and sigma L, and it gives us quite a good model of what the price movement has been. And you can see that price is of course expected to bounce out of the 20-week cycle trough, give us a move up to the beginning of August. I see Stuart has said, when will the intraday plugin come online? That's the plugin for the MetaTrader 4 trading platform. It's going to be fairly soon. I've had to learn in software development you never give exact times. It's fairly soon. Most of the development is complete. We're finalizing things on it, so there's not going to be very long to wait. We're pushing out the new version of Sentient Trader first, and because the Sentient Trader, the Hurst Cycles plugin, is supported by the new version of the Sentient Trader. Najmuddin, as per Hurst, during a fundamental interaction, the amplitudes of the shorter-term waves increases, but wave period does not change much. Is this true? And Thomas is checking for updates every hour. Okay. Najmuddin, the relationship between wave periods and amplitudes is a really fascinating discussion. And of course, yes, I think that you're right in saying amplitudes increase tremendously. Wave period does not change much. I'm not sure that it's true that wave period does not change very much. I think that wave period, I've seen examples of wave periods also changing quite a lot during those really very, very strong moves. I'm not sure that I can find any good examples. But yeah, I'm afraid I can't find any examples. I haven't sort of prepared anything here in terms of having a look at those wavelengths. But I think you will find that this wavelength here for the one-day cycle. So here's a trough of the one-day cycle at the foot of the chart, and this wavelength here to the next one-day cycle was very compressed, in my opinion. Can't actually measure it right now, but I think if you measure that, you'll find that the wavelength also gets very compressed. But again, you must remember that a lot of that has to do with the fact that it might be not very meaningful. It's possible that this was just an overnight panic, not panic, but a moving of the goalposts thanks to the Brexit, and that in fact the one-day cycle trough, should be at that position over there or that position over there. But because of the tremendous distortion in price movement, you can't really accurately position those cycle troughs. Is what happens, in my opinion. Okay, and Najmuddin says it's what Hurst mentions in chapter 5 of his course. That's right. He speaks about it in. He certainly speaks about it in his course. Thank you for mentioning that it's chapter 5. And William saying that Najmuddin is correct with respect to the very short intraday waves. Okay, so I think you get compression of wavelength as well as tremendous sort of change of amplitude as well. Both things happen, which makes it very difficult to trade purely on the basis of a cycles analysis. Okay, let's go and take a quick look at the S&P 500. Because we've been speaking about the S&P 500 and we've been speaking about trading the S&P 500, and again this is a chart that you're very familiar with. And let me pop up that 20-week FLD. You'll know that over the past several webinars we've been speaking about this analysis. Here is a trough of at least I've used the wrong pen there. Let me see if I'm so complicated with all these different pens. Here's a trough of at least 18-month magnitude in early February. You can see that, in fact, this particular analysis shows it as being a trough of the 9-year cycle. Let's not have that discussion again. I believe it is a trough of at least 18-month magnitude. And, of course, we had lots of discussions surrounding this trough over here, where price came down to the 20-week FLD and bounced up away from it. And we entered into, or discussed entering into, a long trade as a result of believing that that was possibly an early 20-week cycle trough. Now, as I mentioned in those webinars at the time, of course, once you enter into a trade, you monitor it very closely to see whether your analysis is remaining true, and you get out of your trade and take your profits as soon as the markets begin to turn around and turn down again and things look a little bit different. So one of the things I really love about trading Hurst cycles is that we potentially entered into a trade over here as price bounced out of what we thought was a 20-week cycle trough. It turned out, with the benefit of hindsight, probably not to have been a 20-week cycle trough. It might have been, and I'm going to come back to that in a moment, but the point is we were able to make a profitable trade even though our analysis wasn't actually entirely correct. So you can see that the analysis on this chart, and I have influenced it a little bit, I've pinned this 80-day cycle trough over here. The analysis on this chart is now showing this as a 40-day cycle trough, which was one of the possibilities that we considered when considering entering into a trade at that point. And it's showing us a rather staggered and distorted nest of lows for the 20-week cycle trough here at the foot of the chart. As a matter of interest, today is rather a special day for the 20-week cycle, because you should know that the average length of the 20-week cycle is 136 days, and 136 days from the trough on the 11th of February was yesterday. So happy 20-week cycle anniversary. Yesterday was the exact day on which we would have expected an average 20-week cycle trough to have formed. And so it seems very likely that that 20-week cycle trough is forming now in the market. Bear in mind, once you have big news events such as Brexit happening, be very careful. The repercussions of that news event weren't all over on Friday. You're going to have people moving those goalposts for some time, and it can take a little bit of time for the markets to settle in. So I'd be very careful about jumping to the conclusion that the 20-week cycle trough has formed, just because, of course, it was expected on Sunday. But you can see how the impact of a vote in the UK affected the markets here in the S&P 500 in the US. And we can also show the composite model line here, and we're seeing a slightly different picture because of the different analysis, but you can see the composite model line is expecting the market to form a trough fairly soon and bounce up to new highs also sometime in August. So let's speak about then what we might expect to be happening in the stock market, seeing as we've had this very dramatic news event influencing the markets. So what are we expecting? Well, as I've mentioned in the webinars preceding this, we certainly don't have a 20-week cycle trough. Well, look, if the price comes all the way down to somewhere around 1900 level, not impossible, but if it does, then we would say, oh gosh, that was a surprise dominant 20-week cycle. But in my opinion, it's still more likely that we have a dominant 40-week cycle. And if we have a dominant 40-week cycle, that means that we have a strong price move upwards, such as we have seen, a little move down into the 20-week cycle trough, followed by another move up, perhaps forming a higher peak or perhaps not forming a higher peak, and then coming down into the 40-week cycle, which we would then expect to be a fairly balanced move. So I've had several people email me since Thursday night asking me whether they should sell all their stocks because of the tremendous volatility in the market. I have to say, for the record, I think the worst thing you can do following a news event is to sell all your stocks because you're frightened by the volatility. The volatility can, of course, be frightening, and you possibly lose a lot of value in your investments. But the cycles have not disappeared. They are going to come back. And if we have a dominant 40-week cycle, then the time to consider selling your stocks is probably going to be sometime in August, as we see this bounce upwards. It is also possible that the 20-week cycle trough is behind us, and that this was the 20-week cycle trough over here, in which case we've seen the strong move up, then the move down to the 20-week cycle trough, then the move up to the next high, and now we are seeing the move down into the 40-week cycle trough. If that is the case, then yes, we have started our strong move down. However, we don't yet have strong enough evidence to show that that very strong move down has started. And even if that is the case, that the 20-week cycle trough is behind us, we are still going to see some sort of bouncing and moving in this market. And so the very worst time to take your money out of the market is the day after the dramatic news event, or a few days after the dramatic news event. If this was the 20-week cycle trough which formed in the middle of May, which is still perfectly possible, then we have seen 36, 39 days since that trough. What does that mean? That means we should expect a trough of the 40-day cycle to form round about now. So we will look for a trough to form fairly soon. If the longer cycles have distinctly turned down, we'll get a little bit of a miserable recovery, and then it's going to turn down again. Now, if that is what happens, and we get a miserable recovery, sorry, that's a difficult word to say when you're speaking fast. If we get a miserable recovery, then yes, of course, then we do need to consider getting out because the big move down has started. The important thing, in my opinion, is to make trading decisions sensibly and confidently. Don't make them the day after a big news event. Because we're humans, what can we do about that? We see prices tumbling. The day after the big news event is when things are very emotional, and that's generally, history has shown us, generally the wrong time to get out of the market. So let me wrap up this webinar. And I see a comment from William saying that's what his analysis shows. So I think William is saying that the 20-week cycle trough is behind us, which means we need to be on our toes. We need to watch for that strong move down into the 40-week cycle trough. So by no means can we sit back and say, oh, don't worry, a 20-week cycle trough is forming, relax. We need to stay on our toes and watch the market carefully. Now, let me come to the last point that I want to make in today's webinar, which is the concept of planned and unplanned news events. Some news events are planned. Brexit was planned. We knew it was going to happen. It was all over the press. Everybody was talking about it. And we knew that on Thursday night, the results were going to be announced. That was a planned news event. You also get unplanned news events. And I'm going to show you what happened when unplanned news events happened. I've chosen 2 unplanned news events, just sort of rather arbitrarily. And we're going to take a look at what happened there very quickly. The important point, I believe, is that planned news events always cause more volatility than unplanned news events. Why? Because of the way in which markets work. Okay. Planned news events means that all those traders that are making the market and are doing their things and moving those goalposts, a planned news event, they have a lot more control over what's happening. Perhaps that's a naive way of looking at it, but it certainly seems to be the case that when you have an unplanned news event, it does cause volatility, but generally it is less dramatic than a planned news event. So that's just something to bear in mind as we move forward, particularly if the dissolution of the European Union continues, as many people are saying it might, and we're going to get several other exits. Italy, for instance, when Italy takes a referendum and decides they want to get out. Or what about France? Somebody suggested that should be called Frenchit, or French exit or something. So it's definitely something to consider. But let me take a look at, I've chosen just 2 other news events just as a matter of interest. First of all, let's go back to the year 2001, 9/11. The 11th of September 2001. Let's zoom in on that time. You all know what happened there. An unplanned news event, or at least not a news event that people who were trading the markets knew about. And so let's just have a look at that and speak a little bit about what that news event caused in the markets. First of all, here is our market moving up and then moving down, right, into its big trough in 2002. This is the S&P 500, the cash index. So 2001 September happened somewhere round about here. Okay, so let's zoom in and work out where exactly it did happen. And you've probably had a look at all of this before, so I won't spend too long sort of discussing all the details. But somewhere in here is the 11th of September 2001, the 9/11 terrorist attacks. And so how would you expect that to make markets move? If news events make markets move, would you expect it to have turned the market down at this point? Or would you have expected it to turn the markets up at this point? Well, let's identify where 9/11 was. 9/11 was over here. Okay, can you see that line that I've drawn there, that roughly vertical line? That's where 9/11 was. Now, if big news events turned markets, then I think you'll agree that that's a slightly sort of disappointing turning of a market, because the market was heading down before the news event, and it continued to head down after the news event, and turned a few weeks later. Okay, we can zoom in and have a look at a little more detail there. Here it is again. Of course, the event opened before the markets officially opened for trade, so they opened on this day. Oh no, I beg your pardon, it was this day over here. Let me draw those arrows again. Those arrows are really horribly skew. So 9/11 was this day here. It was a Tuesday, is that right? So here is the 10th of September, the Monday. Here's the Tuesday, the 11th. The markets didn't open, and in fact they didn't open for about a week, and here they did eventually open, and the markets dropped. And everybody was holding their breath during this week when the markets weren't open, wondering what was going to happen. And of course, lots of people said, yes, the markets are going to drop because of terrorist attacks. But did they drop because of terrorist attacks, or did they drop because of volatility, or did they drop because the cycles were still looking to form a 20-week cycle trough? I'll let you make your own decision about that. Let's take another look at another unplanned news event. And I thought it would be really interesting, actually, because I discovered I had data for this, to go and have a look at a time when I wasn't even trading markets. And in fact, it was a long time before I was born, in 1963. I don't know how many of you know what happened on the 22nd of November 1963, but there was a fairly big news event. An unplanned news event. Well, again, people who were trading the markets didn't know that it was planned. And I've got the wrong date there. There we go. November 1963. Here we go. And let's zoom in and have a look. I don't have a cycle analysis at the foot of the chart at this point, but that's not really the important point. But on the 22nd of November 1963, J.F. Kennedy was assassinated. And that was a very big news event that, of course, caused ripples around the world. The markets were a different thing in those days. You didn't have, minute-by-minute electronic online trading in those days. But nevertheless, that very big news event caused tremendous volatility in the market. Can you see the 23rd of November? It was a Friday, and it is this bar over here. Oh, that arrow is really skewed, but it's that big bar. Okay, that really big bar there, where the market dropped very strongly. Now, again, I ask you, did the market drop very strongly into that trough? And that looks like a trough of, let's see if we can measure some bars. Was that a trough of 20-week magnitude? Probably. That's 123 bars, 17.6 weeks. So was that a 20-week cycle trough? And as you can see, there was volatility surrounding the announcement of JFK's assassination, and the market dropped very strongly. It spent the whole day dropping, and it closed at its lowest point. On the Monday, I believe the stock markets were closed in honor of JFK, and so the next day of trading was on the Tuesday, but you can see what happened on the Tuesday, which is this bar over here. The markets started pretty much where they'd closed on the Thursday, and they just bounced upwards from there. So I think that's a really interesting look at what news events did. What's that? 53 years ago. 53 years ago, big news events, and this was an unplanned news event. Big news events affected the markets and caused tremendous volatility, but didn't necessarily turn the markets. Well, you might argue that JFK's assassination caused that 20-week cycle turn, but in my opinion, the turn happened because of the cycles, but then I'm a bit obsessed by cycles, and it was merely volatility that was caused as a result of that very strong move. So that brings me to an end of today's webinar. I hope you found it really interesting to consider how fundamental news events affect markets. The important points, I believe, are that planned news events that we know are coming, affect markets, and they affect markets to a much greater degree than unplanned news events, which in my opinion supports my argument that news events are merely sort of big price action volatility caused by people moving the goalposts because they are able to know that the news event is happening, and they're able to control the situation and get involved in the market. And I don't wish to sound like a conspiracy theorist talking about market manipulation. It's not market manipulation, it's simply the way that markets work. Okay, the important thing, in my opinion, is to be prepared. Know when news events are going to happen. Obviously, you cannot know when unplanned news events are going to happen, but you can know when planned events are going to happen, and be very careful of them because they will cause strong volatility. And they can also often be the trigger for moves that you've been expecting from a cycle point of view. So you could argue we've been expecting price to fall down into the 20-week cycle trough, or perhaps if the 20-week cycle trough is behind us, we've been expecting some kind of a trigger to turn those markets down for the move into the 40-week cycle trough. And often news events will be those triggers. So you need to be very careful of them. If you're going to trade the news events, then you need to know what you're doing and probably research other tools that you can use to support and bolster your Hurst cycles analysis. If you are focusing only on your Hurst cycles, then I would recommend that you exercise caution when news events are approaching, and probably just stay clear of the markets, let the dust settle before getting back into trading your cycles. Thank you very much for joining me in today's webinar. I do hope that you've found it useful, and I look forward to seeing you in our next webinar, which is going to be in 2 weeks' time. And I wish you, of course, as always, profitable trading, and I look forward to seeing you then.